I'm Diana Hoff with Mountain West IRA. Today, we're diving into a topic that many IRA holders have never heard of, but that can be really important if you own alternative assets inside of a retirement account. We're talking about in-kind distributions. If you have a self-directed IRA holding real estate, precious metals, private stock, or other non-traditional assets, understanding this option can completely change how you think about distributions. In this video, we'll cover what in-kind distributions are, how the process works, the tax implications, how they can be used for required minimum distributions, when they may and may not make sense, and common mistakes to avoid. By the end, you'll understand an often overlooked strategy that gives you more flexibility and control over your retirement assets. Let's start with the foundation. What are in-kind distributions? Most people assume IRA distributions only happen one way. You sell your investment, it goes back into the account, and then you take a distribution in cash. So it's always cash. That is the most common method, but it's not the only one. An in-kind distribution means you receive the actual asset from your IRA instead of selling it for cash. The ownership of the asset transfers from the IRA to you personally. For example, if your IRA owns a rental property, an in-kind distribution transfers the property from the IRA into your personal name. If your IRA holds physical gold or silver, the metals are shipped to you instead of being sold and then taking the distribution in cash. Or if your IRA owns private company shares, private stock, those shares are re-registered to your personal ownership. The investment doesn't change, only the ownership changes. This distribution method can apply to traditional IRAs, Roth IRAs, SEP, simple IRAs. It's not a special account type. It's simply a different way to take a distribution. Understanding the steps of how the process works sets realistic expectations. Step 1, notify your custodian. You contact your IRA custodian and request an in-kind distribution of a specific asset. Every custodian has procedures and documentation required. Step 2, determine fair market value. This step is absolutely critical. The IRS requires a current fair market value at the time of the distribution. That value determines the reportable distribution amount. So for example, real estate typically requires a professional appraisal. Private company stock often requires a formal business valuation. Precious metals are valued based on recognized market pricing, like the spot price of that day. The valuation becomes the amount reported on Form 1099-R. Step 3, submit distribution paperwork. You complete the required distribution forms and include valuation documentation. Step 4, transfer ownership. The transfer process depends on the asset type. Real estate requires preparation and recording of a new deed. Precious metals require insured shipment and documentation. Private stock requires updated ownership records with the company. So now the other part, step 5, tax reporting. Your custodian or administrator issues Form 1099-R, which reflects the fair market value of the asset distributed. You report this on your tax return just like any other distribution. It's important to understand that in-kind distributions typically take longer than cash distributions. Appraisals, shipping, title transfers, all of that requires time. If timing matters, especially for year-end planning, start early. Okay, let's talk about tax implications. The tax treatment of an in-kind distribution is the same as a cash distribution. The IRS doesn't distinguish between receiving the property and receiving the money. The taxable amount is based on fair market value at the time of distribution. So you're still getting charged for that value, whether it's $10,000 in cash or $10,000 in silver coins. The value is still $10,000. That's going to be what's on your 1099. So for a traditional IRA, the fair market value of the asset becomes taxable ordinary income. If you distribute real estate valued at $150,000, that full amount is going to be reported as income for that year. Federal, and depending on where you live, possibly state income taxes are going to apply. If you're under age 59 and a half and no exception applies, the early distribution penalty may also apply. Okay, how about a Roth IRA? If the distribution is qualified, meaning age and holding requirements are satisfied, the distribution may be tax-free. If it's not qualified, earnings may be taxable and possibly subject to penalties. Here's a critical point. You receive property, not cash, but the tax obligation is based on the value of that property. That's important to remember. If you distribute a $100,000 asset from a traditional IRA, you may owe taxes on that $100,000. You must have other funds available personally to cover that tax liability at tax time. This is one of the most important planning considerations with in-kind distributions. So let's talk about RMDs and in-kind distributions. We had a few of those this year. In-kind distributions can play a strategic role in required minimum distributions. Once you reach the age when RMDs apply, traditional accounts, pre-tax accounts require annual distributions. Many people assume that this means selling investments to generate cash. However, RMDs can be satisfied in kind. If your RMD amount for the year is $30,000 and your IRA holds assets worth at least that amount, you can distribute assets equal to the required value instead of selling them. The fair market value of the distributed asset counts towards your RMD requirement. You'll still owe income tax on the distributed amount in a traditional IRA, but you are not forced to liquidate the investment inside of the account. This approach can be particularly useful for alternative assets where selling may not be ideal due to timing, market conditions, or even long-term strategy. So, when do in-kind distributions make sense? In-kind distributions are very situational. They are not universally appropriate. They may make sense when You want to continue holding an asset personally after it leaves the IRA. You believe the asset may appreciate further and prefer personal ownership. You want to occupy or personally use property that was held in the IRA. You're managing RMD obligations without liquidating investments. Or market conditions, which can get a little wonky sometimes, are unfavorable for selling. They may not make sense when you plan to sell the asset immediately anyway, or you don't have outside funds to cover the tax liability. The asset is difficult to value or to transfer, or even if administrative complexity outweighs potential benefits. Every situation is different. Understanding the mechanics allows you to evaluate whether this approach aligns with your broader retirement planning strategy. So let's talk about working with your administrator. Not all custodians and administrators handle in-kind distributions the same way. Some may restrict certain asset types, others may require extensive documentation. Timelines can vary significantly. If you hold alternative assets in a self-directed IRA, it's important to confirm whether an in-kind distribution is permitted for the asset type, what valuation standards are required, what documentation must be submitted, and how long the process typically takes. Custodians and administrators that specialize in self-directed accounts and alternative investment assets are more often familiar with these processes. Clear communication before beginning the process can prevent a lot of delays. Let's talk about common mistakes to avoid. Understanding common pitfalls can help you avoid complications. So, mistake 1, assuming in-kind distributions avoid taxes. They do not. The tax treatment is the same as cash distributions. Mistake 2, waiting until the last minute. Valuations and transfers take time. Start early, especially for year-end deadlines. Mistake 3, using unsupported valuations. Improper valuation documentation can create compliance concerns. Never a good thing. Mistake 4, not confirming your custodian's procedures. Never assume, always verify. It only takes a phone call. Mistake 5, forgetting about tax payment planning. You receive property, but taxes are due in cash. Avoiding those issues makes the process smoother and a lot more predictable. In-kind distributions provide flexibility that many retirement account holders don't even realize exists. They allow you to maintain control over when assets are sold, strategically manage RMDs, transfer alternative assets into personal ownership, and preserve long-term investment strategies. The key is understanding the mechanics, tax implications, and administrative requirements before moving forward. This video is for educational purposes only. Mountain West IRA is a neutral third-party administrator. We don't provide tax, legal, or investment advice. Remember to always consult your CPA, tax professional, financial advisor, or even your attorney regarding your specific circumstances. For more educational resources on self-directed IRAs and alternative assets, visit www.mountainwestira.com. Thank you for watching, and I hope you have a fantastic day. Bye.